Tim Kolterman. I am a partner and chief investment officer at Rockstep Capital. Rockstep is a 25-year-old commercial real estate company located in Houston, Texas. It was founded by my partner, Andy Weiner, again, about 25 years ago. During the course of those 25 years, we've invested in north of 35 assets, all in the retail space, whether it be malls, power centers, or shopping centers, which are kind of like large strip centers, throughout the country. Currently, we own 25 assets in 11 states, over 8 million square feet. During our life, we've returned north of 30% IRR, with better than a 2.5 times multiple on investment capital. Our strategy has obviously changed. It had to change a great deal over the past 25 years. First, it was a core strategy, then a core plus strategy, and now it's a contrarian strategy. But nonetheless, we bring the scope of Rockstep Capital to every investment we make. We're a vertically integrated company, meaning we have construction, leasing, acquisitions, investor relations, accounting, all of that under one roof so that we can contain costs. I've been in the real estate business for over 30 years, and primarily in private equity, starting with J&B Realty in Chicago, and then had a 15-year hiatus on Wall Street, and then the last 13 years in private equity. And I can tell you that Rockstep Capital operates more efficiently than any company that I've ever worked for because of the cost containment. It's significantly more expensive to Andy and I to run a vertically integrated company, but ultimately it ends up in pretty good returns over the last 25 years. Okay, I'm trying to balance that, but nonetheless, we have two strategies that we run. We run a value strategy that I'll talk about in a minute. As an example, I will be talking to you about an investment that we are making right now and hope to close in August. But we also have a mall repositioning strategy. We currently have 8 malls that kind of qualify as mall repositioning candidates, where we buy a mall that oftentimes will have one or several anchor boxes that are empty. But the market right now, as you would expect, is very negative on the retail space. And as a consequence, we're able to purchase the asset at literally unprecedented levels. As an example, a couple of deals that we've been involved in over the past, call it 6 months. There was one asset in Colorado that about 3 years ago was capitalized for $365 million, that ultimately transacted at $45 million. Unfortunately, we were the second place bidder on that. And we are under contract right now to buy an asset that was, again, about 3 years ago, was capitalized with $125 million of debt and equity, and we're going to be buying that asset for $12.1 million. Obviously, it's a terrible situation for those investors that formerly invested in the asset. I'd like to make the case that for those that are invested with us in the assets that I just spoke of, and others that we own, will be able to take advantage of that basis. If you think about the concept of a mall, generally speaking, they are located in very dense locations with good demographics, great transportation, rooftops all around them, and generally, strong credits that are selling their materials there. At the end of the day, we look at the mall repositioning strategy just to really create communities. No longer is the case where we can go in and just re-retail the position. It's our view that we want to remove or come as close to it as we can to removing retail beta from our cash flows. What we want to do is we want to create a situation where we're going to go in and take an empty anchor and create 200 to 500 multifamily units, or build a low-rise office building, or in the case of an asset that we're buying now, building a 1 million square foot hospital for them. And then subsequently, we will reduce the amount of retail. And in some cases, it might be a hospital on one side of the mall and a multifamily units on the other, or e-commerce fulfillment and distribution in the middle. And the resulting retail, on average, if you think about a regional mall, you might have somewhere between 500,000 and 600,000 square feet of what we call inline retail, the Victoria's Secrets, the women's shoes, the men's tennis shoes, that kind of stuff. We would be reducing that to somewhere around 200,000 square feet. And the remaining retail is, again, supplementary to the uses that we are creating. So in our vernacular, we talk in terms of cap rate rather than in the corporate space of multiple. Our cap rates that we're buying asset now is in the 20 to 25%. The latest asset that we're buying for $12.1 million, we're buying it for 75% of a recent large tract land transaction in that area. So if you think about it, we can scrape the whole thing and sell it for homes and be even. So that kind of, if you think about your investments today that you're considering, SPACs or otherwise, think about whether or not you have an internal hedge in your equity investment. And that's exactly how we're thinking about it now. While we are a contrarian investor, we think more about risk management than we do just the outright equity risk. The one asset that I would like to talk about as an example of the value asset or the value strategy that we have is we are under contract to buy 34 shopping centers across the country in 14 states. We are buying this portfolio. We've been under contract since May. We're finishing our due diligence the middle of next month and probably closing, or not probably, we will be closing by the end of August of this year. The reason why it's a value transaction is two reasons. One, the seller is a offshore pension fund that the vehicle that owns this portfolio has actually expired, and they had to dispose of the assets prior to COVID. They were trying to sell the assets individually, which is by far the highest NPV project, and they ran out of time. COVID came in, the world shut down, and now, I don't know, 16 months later, whatever it is, they have to sell. So we are buying the asset at an 8.3 cap rate. The shopping centers are what's called shadow anchored by super Walmarts. Super Walmarts being 50% grocery stores and 50% all the other stuff that Walmart sells. But the good news there is that the Super Walmart in each 34 location is by far the dominant grocery store within approximately 20 to 30 miles. So we've got great statistics that show that the Super Walmarts are performing extremely well. And as a result, the tenants in our shopping centers have been very sticky. 70% of our tenants have been in place for over 10 years. 70. 40% of our portfolio is 100% leased. Another 40% of our collateral has one vacancy. One. So that's kind of a testament to not only the manager that we're buying it from, but to Super Walmart. People got to eat. And during COVID, grocery stores have performed extremely well. And, you know, this portfolio, and another reason why this is a value transaction is that the portfolio lost some occupancy. Despite 80% of the portfolio being in very good shape, the remaining 20 is somewhere between, call it 50 and 80% occupied. So between, over the last 10 years, the historical occupancy of the portfolio has been 94 to 95% leased and occupied. Now it's 90.4. So when you think about, when I think about a value investment, I like to break out the absolute returns or the contribution to each return. In my mind, about 65% of the return is coming from where we're buying the asset. Just because we bought it cheap and the seller had to sell, the cap rate at 8.3, the weighted average of the cap rates of the individual assets over the last couple of years is 6.93. So when you add all of that value up, you get to be about, we think that we're going to make, we're buying the asset for approximately $109 million. All in all, we think we're going to make, on a pro forma basis, we'll make about $40 million. And about 65% of that comes from that cap rate arbitrage, if you will. And the other component is the lease up of that 20% of that collateral, which, again, we are a national company with national relationships. And we feel very, very confident that leasing up a center that has been 94% occupied over the last 10 years with a dramatically important grocer in tow is a pretty good bet to us. One note about COVID, grocery anchored shopping centers have lost over the last 16, 18 months on a national basis. Again, I said we lost about 3 or 4 points of occupancy. On a national basis, retail has lost about 12. So again, we're very confident that we'll be able to pick up that other 35% of that value. So that's some very quick comments about our company, our investment thesis, as well as our current investment. And I don't have the chat room in front of me or anything, but I've got one comment right here, so, or question.
Can I speak this way or down here?
Just repeat your question so the audience can hear.
Okay.
Sure.
I just wonder whether this is sort of a tale of two cities. I'm sorry. On the one hand, you're buying a depressed asset for incredible value.
Mm-hmm.
You're going to need a lot of capital to do things with those assets, I believe. And on the other hand, you're talking about you've been in business for a long
25
time.
years.
So haven't you suffered some of the vicissitudes of that marketplace, forgive me? And where do you stand financially, where you're gonna need a lot of capital to grow on my right hand, I have your opportunities, and on my left hand, it's the last, 2 to 3 years of the mall business, whether it's 2 years, 7 years, you're the expert. So haven't you had some difficulty on the left hand, and how is that gonna support your right hand?
Sure, great question. The answer is yes. We particularly, oh, sorry, yes. Thank you for reminding me. The question is, hasn't Rockstep over the last, 7, 10 years since retail has become an unfavored nation, haven't we suffered? And as a result of that, is Rockstep in a position to effectively capitalize this new transaction? It's a great question. The answer is Rockstep has suffered a little bit. The last year was terrible. If you talk to any retailer, or any landlord of retail across the country, they say they did fine. They're lying. It was a pain in the neck. But financially, we did not lose one asset. We are now the saying that the death of retail is, or the comment of that has in my mind been greatly exaggerated. There are, off the top of my head, 10 retailers that are expanding. Now they're expanding in an intelligent way because they have leverage. Instead of paying 10% or 15% of sales, now the going rate is 5 to 7. But I can tell you that since January, our leasing department, again, pretty national, has never been busier. We are seeing, not surprisingly, since grocery stores have done so well in COVID, there are some huge chains that are moving into different markets. Even offshore grocery stores like Aldi, I don't know if you guys have ever heard of Aldi. Aldi is growing like a weed throughout the country. They're a very good customer of ours. So Rockstep is doing fine. We've done very well over time. In fact, we just monetized the deal in the face of COVID and returned to investors well north of 25%. As it relates to an individual investment, Rockstep has brought in anywhere from 85% on a high side to a low of, well, actually a low of 0 of limited partners. So in this case, a large asset like this, we will distribute or invite limited partners to invest in our deal with us, and we will use some of that investment for the capital needs of the asset. So does that answer your question?
Yeah.
Great.
You're going to get your deck up if you want to walk through it.
Well, I kind of just did, but you can hit. Excuse me? No, but I'm glad you asked that. We have been real estate syndicators for 25 years, doing it the hard way, one asset by another. For many years, we have thought that we should be judged on the last asset that we've invested on. We thought that that was the most ethical way to do it. It was by far not the easy way to do it. And now raising equity in a commingled fund manner is not at all easy either. And despite our 25 years of track record, we are, quote unquote, an emerging manager. With gray hair of mine and the gray hair of my partner, that would seem a little odd, but nonetheless. we are, while we are still very, very interested in bringing on new limited partners, we are starting to investigate either the fund or separate account way, because maybe not similar to this, but particularly in the mall repositioning strategy where there's so much distress in the market, and you're buying distressed loans where you have to foreclose on the equity, that closing process is much different. It's not 90 days, 60 days of due diligence followed by another 30 days to close the deal. You need the money in 10, 15 days, period. So one, you got to really know what you're doing because it's very dangerous. Luckily, we've got a lot of experience doing this. But the access to capital, and access to significant capital is really important. And the deal that I told you about initially, which was located right outside of Denver, $365 million of value that traded for $45.1 million. And yes, I was the stupid guy that bid $45 million, but that traded in 10 days, literally 10 days. And we were the second place bidder. The winning bid had bid $100,000 more than me. And I lost the deal, and it was in our model, a minimum 25% IRR deal. So yeah, I'm the dumb guy in the room. So that I didn't pay $150,000 more, but nonetheless. But distressed real estate trades, I was in the fixed income market running commercial mortgage-backed securities trading desks for many years. There's a term that says something trades on the wire. That means like trading right now on the phone. I don't want to get to be in a position where distressed real estate trades that way, but it is leaning that direction. So the way in which, to answer your question then, the way in which we're capitalized will say a lot about our success in acquiring assets. It makes it more difficult, but so that's bad. On the other hand, there's a concept, I think, that's happening right now where the wheat is being separated from the chaff, that these big repositioning plays, I'm not kidding, there are fewer than 7, 8 guys in the country that do what we do and that can assess and put any number of uses in place in an asset. So in one sense, it's bad because it's very difficult to get the money and it's very difficult to assess.
Bye,
But
bud.
on
Have
the other hand,
fun.
there are very few bidders. Did I say something wrong?
Have fun.
Yes, exactly. Exactly, exactly, exactly.
So there's a question from the audience. How much of the mall space you buy is repurposed? What percent to other functions, and how much remains in retail?
Right now, we think that there is anywhere from $20 to $35 billion of malls in the country that are worth zero, less than the debt. So there is, we buy 1 out of 20 deals that we see that we really think are worth putting the time and effort into it.
When you step in, what percent are repurposed?
Oh, when we step in, 70% of them.
70%.
Yeah, we're not interested in retail only. Retail only, owning retail beta is not what we're about anymore. And what we want to do is we want to create assets at land value, 20-25% cap rates, and create mixed-use assets, schools, e-commerce fulfillment, office buildings, multifamily, that collectively trade at 4 or 5, and then exit at an 8, or something like that.
Do you think development first then?
Yes. In some cases, yes. In this Walmart deal, it's 95% or 90% occupied. There's none of that in that. But we've bought in a deal the deal that I talked about that we're buying for $12.1 million. More than likely what we will do, there's a senior living component of that deal. What we will do is we will contribute. It's actually not part of the center. We're buying land along with it. We're going to contribute the entitlements and the land as our equity, and we'll put it over here into another joint venture with a senior living developer. And the developer will come in with money and his recourse and the debt, and he'll build it, and we'll have like a 60 to 70% carried interest in the deal. So that's the way we de-risk the asset as well. Yes, sir.
Just quickly, we're all interested in how we're going to recover in these different industries. Where's the 25 to 30 billion of malls that are below debt level? What's your vision about that? Where are we going with those?
Some of them, the question was, where is the distressed assets that are worth less than land value or less than their debt? Where are they going? In some cases, they're going to be really interesting warehouses, really interesting complete scrapes, meaning wipe them out and build houses on them. In some cases, they're going to be redeveloped by Rockstep Capital into new communities. But not all of them are the same. We want to do it, if you see assets like that in gateway markets like New York City or Boston or San Francisco, they're way too expensive for our taste. We'll have to pay a 7 cap for that kind of opportunity in New York City or around New York, meaning. But St. Louis, Milwaukee, San Jose, you get the drill. Those are some really interesting value plays that still have the demographics, the growth that that we need for success like that.
Why are they in that position? Attractive have the demographics to have the growth.
Because the question is why, effectively, why is there the opportunity if they've got so many great characteristics that Rockstep Capital wants to buy, why are they trading so cheaply? Fair? They're trading so cheaply because I'm a real estate guy, so I apologize. The exercise to get from an asset that has 3 empty anchors that has agreements in place that preclude development, which are called reciprocal easement agreements, that have those in place, maybe with an existing anchor, is pretty tough calculus. You need a very, very experienced operator. You need a company that understands municipal finance. You need a company that knows how to develop assets or has relationships with other developers. And like I said before, there are just very, very few companies like ours in the country for a market that's $35 billion wide. And it's a great position. I mean, again, I was in the fixed income market. I ran real estate private equity and fixed income specialty finance for years. I've never, ever seen a relative value opportunity in any financial market, but particularly in real estate that I've never seen. If you want to take development risk and build an e-commerce fulfillment a warehouse spec, you're going to have to pay. You're going to build it, what we call build it at a 4 and sell it at a 3.5% cap rate. Whereas I can do my thing with better, that's spec, with not a tenant in the world praying that Jeff Bezos says, you're my favorite in this market. Or I can buy mall assets that across the country are as good as you can find from a location perspective and buy it at land value at a 25% cap.
We've got time for one last question. With, Rob, do you have a question?
Local political opposition, residential,
Yeah.
not quite that easy.
Right. The question is how do we deal with municipalities vis-a-vis zoning and the challenges that brings? Really the question, you're exactly right, the zoning issue is really not so much a use issue. It's a little bit traffic. Like if you're going to build e-commerce fulfillment and half of the parking lot of your mall is going to be filled with those kind of sprinter vans, the tall vans, that's a little bit of a problem. But more times than not, the zoning issue is regarding taxes, because retail receipts are the highest taxed item in most municipalities across the country. And they're reluctant, meaning the municipalities are reluctant to give up that hope that you're going to be able to fill that 120,000 square feet with another retail that'll generate tax receipts. But now this is, I mean, the most important thing you guys have all heard about real estate, the most important thing about real estate is location, location, location. I think it's really timing, timing, timing. Because now we're at a point where municipalities have been looking at empty malls for 5-7 years. And they're starting to be blighted. And that's a good time for us to come in and buy assets. Thank you.
Thanks so much, Tim. Great job.